All right, welcome to cost accounting. We are today going to be dealing with transfer pricing. And it's actually amazing that we didn't have this on the last assignment that we were doing for the costing guys, because I think from my point of view, our examiners do think this is a very important topic. So it's highly examinable. That's what I really mean to say there. So it's something that we should, it's very short, and it's something that we should take very serious, right? We're not going to handle this with kids clubs. All right, so when we start talking about transfer pricing, we are now particularly dealing with situations where the organization has got divisions, has different divisions. It's a division. How do I even pronounce that? Okay, basically with divisions, it's got a structure whereby it has got many segments within the same organization. Pity now I can't pronounce the big word. It's too early for that. It's in the morning. All right. So now it's a circumstance where, say, one product, or let's say one division's inputs are the outputs of another division. So within the same organization. So we are, say, you look at what maybe you guys would have done in accounting. It's under group accounting. Let's say we are all under one ownership, right? And then we decide to be buying within the group. So under these divisions, an organization, of course, has the option to buy from outside, or has the option to supply outside to the outside market, or to supply internally within the organization, right? Or of course, if you look at it in the other way, let's try and pick up an example, a simple example. Let's say we have got division A and division B, right? And then we could be manufacturing. Let's say if we think of a product that can be sold externally, let's just say we are dealing with right, let's say it's a farm, right? Let's say we have a farm within our division, and then on division A, we are doing milk on division A, and then here we are doing cheese, right? So in order for division B to make their cheese, they will need milk, but they have the option to get this milk either internally from division A or to get it from an external source. So there are there are a lot of things that you take into consideration, of course, if you want to try and come up with a decision or the right thing to do under these circumstances, which obviously includes the price, which includes the right price. So which is what brings us here to transfer pricing. So transfer pricing, you are basically trying to decide what price this milk can be transferred to the other department, or to the other division, right? And the other things that you find here when you are dealing with divisions is, of course, when you are measuring the performance of a division, you're obviously going to be looking at, I think, the things that we had in the assignment, which is the ROI, etc. I think the question paper that we're going to look at does have that, but we'll see how much time we have. If we have enough time, we will cover that as well. So here it's about deciding the right price to transfer milk, in this example, from department A to department B. So if the price is a bad price, so okay, there are certain things that we need to look at now, because we are dealing with divisions within the organization, and I just spoke about just now measuring the performance of a division, for instance. So if there's going to be a situation where, let's say, you wanna pay bonuses to the managers in division A and the managers in division B based on their performance, right? It means that the performance needs to be measured, right? And then one of the ways in which you can measure the performance, or one of the inputs in our measurement methods for the profits would be, or sorry, for the performance of a division would of course be the profit of a division. And you know that in order for you to calculate the profit, then you will have to come up with a selling price, or to get the selling price and multiply it by the number of units to get the revenue that that division is making. So which means if division A is going to be transferring milk to division B, so it's important what price they transfer that milk at, right? If we are going to be measuring their performance using their profit as an input in one of the measurement methods. So which means how you calculate the profit is important, but not just that, what the selling price is for that. So for instance, if the selling price is too small, right, based on the fact that we are the same company, so if the selling price can be small, it can sometimes be below the cost, right? Under those circumstances, it might now seem like the division is not performing well, right? It might now look like the division is not performing well, merely because now they've had to transfer an input to the next, to the next department or to the next division at a compromised price. But again, assuming that we are working at the head office now, these profits are inter-divisional profits, right? So they are just as good as intercompany profits. So it's not really something that you can celebrate yet. It's not something that you can celebrate yet. You only celebrate a profit that you make to an outside entity. So let's say if these A and B, like in our example, are one organization, then if A is selling to B at a profit, then it's not really a profit because we are the same organization. So it's only a profit if A is selling at a profit to, let's say, company C, which is an external company, which is a company that is not part of our operations, a company that's not within the same group of companies. So we can only recognize such a profit. So I say this to say this now. When you have, when you are dealing with this now, it's important, particularly at head office level, right, to come up with the optimum prices or the best prices that you can give to each other within the organization. It's like you and your brothers. Let's say you are a company, right? Your family is a company. So if your brother is selling you something at a profit, from the family's perspective, it's not really, you have not exactly made a profit because you've simply transferred funds from, or you've simply transferred profit from one entity to another, but still within the organization. But once you guys can sell this to external parties, then that way it becomes a profit. So practically speaking now, I already mentioned that the price is going to be important, of course, guided by a number of factors, right? A number of factors that are most of the time specific to the organization or specific to the scenario that you are given, right? As to what price is important. Let me give an example here. If you have, let's say, this is not something that's examinable, but this is something that can help us bring this to perspective, right? Let's say we are the same company doing milk and cheese, right? So milk you can sell to the market, to the outside market at profit, and cheese, again, you have to sell it to the outside market because in this example, you can't, of course, sell cheese to A, right? But A can sell to B, right? But suppose now A is in, let's say it's in Uganda, right? This is just an example. So let's say A is in Uganda and we are here in South Africa doing cheese, right? We are here in South Africa doing cheese, right? So because Uganda, the company that's in Uganda, the company A that's in Uganda is owned by the same company that owns B, right? So in other words, this is just one company, right? This is just one company. But now if you consider that this company in this Ugandan company, which is company A, is registered in Uganda, right? It has its main operations in Uganda. The cattle is there in Uganda. They are milking in Uganda. So there's a possibility now that we can produce the milk in Uganda and resell it beside in South Africa, in our other company that's in South Africa, and then make a profit likewise. So from a head office perspective now, some of the factors that you take into consideration now is how much is the milk, say, in Uganda, right? So if you're going to sell it to the market in Uganda, how much are you going to sell that milk for? All right. Then you calculate the profit there. And then what about the cheese? If, let's say, because this is costing now, we can easily run the calculations, right? Let's say we buy the milk from Uganda, right? And then we decide to come in and use that milk as an input here, in our plant in South Africa, and then decide to sell this. Maybe we are exporting this cheese to Germany, right? How much are we going to gain from that? So you compare the gain, say, in Uganda versus the gain that you get after selling this cheese to Germany, and then you can decide, okay, where are we profiting the most? Okay, so this is where marginal costing principles come into play. Right? This is where those contribution, for instance, comes into play. Right? You can, of course, do again a full profit calculation, but the most appropriate would be a contribution to see how much contribution do we get to sell this, for instance, in the local market in Uganda versus us selling this here to South Africa and then pushing this through to an external customer, to a foreign customer. Where are we gaining the most? You see, those are some of the considerations that come into play here. Consider again tax consequences, right? The tax issues that are related. Sometimes companies use transfer pricing or transfer products between or within the same company in different locations for tax purposes, right? You find that tax in Uganda is 35%, corporate tax in Uganda is 35%. Here in South Africa, the tax is, say, it's 28%, right? So you'd rather not make a profit in Uganda, right? And transfer your products all the way to South Africa, where the tax is cheap. I think this is logical enough. So this can also work even if you are dealing with finished products. Let's say we are again doing cheese here, right? Let's say we are also doing cheese in dealing with cheese in Uganda. So which means you can make your cheese here and then sell your cheese very cheap to South Africa, right? So that you can avoid paying that 35% tax on your profit. And then once it gets here, then you can sell it and then make a 28% profit like that. But again, like I'm saying, circumstances are dependent on the companies, right? Circumstances are dependent on companies, on the scenario that's given. So we don't have rules on this, right? We don't have hard and fast rules on this. The only thing that you need to do is to read the circumstances and then try and think about what would be appropriate under those circumstances, both quantitative factors and qualitative factors you want to take into consideration there. Right. So the best transfer price now, or the different prices that you can make use of between divisions, it's either you can use the market price, right? You can use the market price. So meaning if you are going to be transferring this from division A to division B, you can simply do that. What's the price of milk in the market? Then you can supply them at that price. Okay. You can supply them at that price. And then again, the other price, the one that we are normally required to calculate this at, would be the incremental costs, incremental manufacturing costs, right? Okay, incremental cost plus the opportunity cost. This is the one that we normally deal with here, right? And then of course, other than that, you can simply charge them at the cost price. No? You can simply charge them at the cost price. Maybe we can as well put that through there as point C. Cost price, which is similar to this, except that you wouldn't have looked at your opportunity cost. So in terms of economics, these are explicit prices here. This is explicit, and then meaning the actual cost that you pay. And then here, all right, let me say economic costs. Let me put it right. Okay. Economic costs, and then these are your accounting costs, which are the explicit costs, the actual costs that you pay, accounting costs. So this of course makes sense. This will of course make sense because division A, for instance, wants to cover all the costs that they've incurred in manufacturing that sort of product that they want to transfer to division B. So in other words, they are not making a loss. And then this again would make a lot more sense because when you consider the opportunity cost is a real cost as well, because we are looking at what the division is losing, right, by transferring that internally. What are they losing? What opportunity are they losing on that? So once you set your transfer price at that, then you want to cover them for that. Okay, you basically want to cater for that, take that into consideration, and then the market price, of course, which is very appropriate, which is good. But again, whichever you choose to use there is very much dependent on the company that on company policies. Take for instance, in terms of the one that I mentioned first, how are you measuring divisional performances? So if there is competition within divisions, then maybe the market price would be the best to go. Yes, maybe the market price would be the best to go. But sometimes if you consider the cost price, for instance, when businesses are expanding, there is what we call vertical integration of organization. So which can be vertical backward. So which is where company B acquires company A, right? For the fact that company A can provide them with inputs, right? So the main company is company B. Now they've bought company A so that they can get access to cheap inputs within their production processes, and then thereby have a competitive edge in the market. So it depends on a number of factors. We can't really have hard and fast rules, like I said. So it depends what the objectives of that whole integration was in the first place, how you measure divisional performances, whether or not there is competition within divisions. So when there is competition, you want to be as fair as possible, right? But again, if you are looking at this from the perspective of the working company, then you want to do what's best for business. Okay. So when they're asking you now to in our questions now, when they are basically asking you to do your okay, no, let's not put right, it's okay, let's leave that in red. So when they're asking you to do your minimum transfer price, they basically want you to calculate this here. This is your minimum transfer price. Then this here would be the maximum transfer price. All right, transfer price. So the minimum transfer price, in reality, the minimum transfer price can be anything, right? It can basically be anything, like the situation that I'm talking about, where you've acquired a company merely for its raw materials. Then you can even get those raw materials for free, right? You can even get the raw materials for free, or whatever the case. But it just depends on circumstances. But here now, we are looking at the fair minimum price, so that we cover all the costs. You see, the maximum price, of course, must be the market price. It must be the market price, because you don't want to buy something, at a price that's higher than the market price. But again, for practical purposes, consider the example that I gave for taxation purposes. Sometimes the fact that sometimes maybe tax could be cheaper where division A is, right? And then more expensive, say, where division B is. So under those circumstances, then if you're going to be doing profit shifting, we call that profit shifting, you will then ask division A to charge you a higher price on the transfer, right? They give you a price that's possibly even higher than market price, right? So that they're going to be taxed, that profit is going to be taxed where division A is. And then once it gets to division B, we are basically, from that location's perspective, we are acquiring raw materials very expensive, so we are unlikely to make a huge profit there. You see, those are some of the, I don't know if that's, I don't think that that's legal though. It's not legal, it's not allowed, it's not ethical. You see, you are basically cheating the state. So sometimes there could be instances where, let's say, we are a republic. Right? Sometimes, let's say, it's a federal state, and then there are certain expenses that are deductible in another, say, in another state. And then if you're looking at a federal situation, you're like talking about countries like, say, the United States and Nigeria, where there are many states within the same country. So the laws are not exactly the same. Yeah. So you can have one division in one state and then the other division in the other state. You see, say maybe if you're in Nigeria, one is going to be in Lagos and then the other is in Port Harcourt. There, you see, then you want to shift your profits from Port Harcourt to Lagos, or from Lagos to Port Harcourt. That's how it is. So we're going to look at an example now. We're going to start this off with an example. All right, this is from. I'm going to share this again after. I'm going to share this after the class, right? And the solution. So we're going to jump straight to, next time we're going to be looking at this here, relevant costing principles. It's got to do with the definitions of our costs. So they normally bring these questions again. This is a whooping 18 marks. So we're going to do this on the next session. So these are our divisions, ladies and gentlemen. And then again, if we have the chance, then we'll calculate our ROI, residual income, and this one here, right? The economic value added. All right, so what we are dealing with is, let's see, I think it should be the last question there, right? I just don't know now if we're ever going to be asked to construct decision trees. Calculation of expected values, probably we will someday, but we will also go through, hopefully. All right, so this is what we are dealing with now. Judd Manufacturing has a valve division that manufactures and sells a standard valve. Right? So the capacity in units. So these are the things that are important in this question. Capacity, first of all. What capacity does the division have? Right? It's 100,000 units. So this division can do 100,000. Then the selling price to external customers is 300. And then the variable cost per unit are 160. And then the fixed cost per unit based on the capacity, that capacity is 90 per unit. So the company has a pump division that could use this valve in one of its pumps, right? The pump division is currently purchasing 10,000 valves per year from a German supplier at a cost of 290 per valve. So assuming that the valve division has ample idle capacity to handle all the pump division's needs. So in other words, let's assume that they can do all the 10,000 without having to sacrifice anything. What is the acceptable range, if any, for the transfer price between the two divisions, right? What's the acceptable range? Right, so, all right, let's change gear, right, and share screen this way. All right, so I'm gonna copy this. So this is only 3 marks, so we are not expecting anything hectic on this one. All right, let's take all this out. All right, so our first assumption now is that we right, our first assumption now is that we have a lot of space, right? That's our first assumption on that now. All right, so I'm just gonna give you now the trick on how we handle these questions, right? On how we handle these questions, so that no matter how this question comes, you are basically in a position to answer any of these questions, right? So what's important, of course, like in any other question, is to know what your objective is, right? In answering these questions, know what your objective is, right? So that's our starting point there. So our starting point is assuming what is the acceptable range. So a range must give you, what must a range give you now? It must give you the minimum price as well as the maximum price, right? That's what a range has to give you. So maybe if you can unmute yourself, yourselves here and tell me what you think, right? Looking at what's given here, what's the acceptable range? This is only 3 marks, so there's nothing complicated here. No calculations. But what range would be acceptable here? What do you guys think on that? Given that we have a capacity of 100,000 selling price, we sell this to external customers at 300,000. Then we manufacture this at 160, right? And then the fixed cost is 90. Right? So what's the acceptable range there?
Mr. Ndando?
Yes.
I think we're gonna multiply the capacity with the fixed, isn't it so?
Multiply this capacity here times. Okay, wait. But I need the price. Let's do the range, the price per unit. So let's forget this one. If you think sell this at 500 rands maximum price with a minimum price of 90 rand, or which one is acceptable? What range would be acceptable? What range do you think both would be acceptable for both divisions, right? Where one division is not gonna cry foul. What do you think? What would you think of that? Anybody? All right, so the acceptable range here, would be the incremental costs. These are the costs, 160, and the maximum price would be 300 here. So why would we say so? Any price that is lower than 160 is a loss for the department, right? It's a loss for the department. So in other words, they'll be better off without manufacturing those valves. So if they go beyond variable cost per unit, they are better off without manufacturing that. So it wouldn't be fair to them. So the least that you can do is to help them recover their incremental production cost, which is the variable cost per unit, right? So in the normal sense, it should be the variable manufacturing cost per unit. And then of course, the fair price is 300 Rand, right? The fair maximum price is 300 Rand. You don't want to sell this to them at a price that is higher than 300 Rand, because they can as well then buy it elsewhere, right? So it's not fair for you to do for them more. So this is the acceptable range between 160 and 300. Right? Let's put that down. So we are being fair. So this is our, okay, let's write it this way. So we said our minimum price, which is our cost to manufacture, is 160 Rand. So which means the price should never go below 160 Rand. Right? For the reason that I gave now, that if it's below 160 Rand, then the division is losing. Right? Division is losing. They are better off without manufacturing that. Right? And then the maximum price is 300. So we put that one. If we sell it at more than 300, then it's a challenge now, because we are taking advantage of the relationship that we have here, you see. So this is the acceptable range right there. So why am I not considering fixed costs? Right? Because these fixed costs are going to be incurred anyway. Right? The fixed costs are going to be incurred anyway. So really, whether or not they manufacture that, it's immaterial, because they are still going to incur these fixed costs. So what these fixed costs are is an irrelevant cost, right? It's an irrelevant cost when it comes to making a decision. So they are unaffected by the decision that we are going to make. So they are irrelevant here, right? So basically, which means the acceptable range, therefore, is going to be that 160, and then it goes right through up until 300, right? But consider again that the pumped division is currently doing this at 290. You see, so 290 is still within that range there, right? It's still within that range there. So which means the best that the division can do for us is to get this at that external price level of 300. Right? That's the best that they can do for us. Anything beyond that then is not fair. All right, and then now, assuming that the valve division is selling all its valves that it can produce to external customers, what is the acceptable range? So if any, for the transfer price between the two divisions. Right, so we are still dealing with that range there. But if you do have any questions, please anytime just drop me and we ask. So now the story has changed, right? The story has changed. So first of all, they did not have, they had ample idle capacity. Now it's not the case, right? Now the rule book has changed, right? The rules of engagement have changed. There's an issue that is coming. So this is the minimum price that we had first, that 160. Now we need to have a different minimum price, because the other division is losing now, because it means, assuming that the valve division is selling all its valves to external customers, what this basically means now is, if they have to sell some of those to us, they have to sacrifice. They need to sacrifice some of the profit that they could have made to external customers, and then bring it over to our side. So which means what we need to calculate here is the minimum transfer price. Right? Now it needs a calculation. Now it needs a calculation, because certain things have changed, right? So for UNISA, most of the questions they ask you, what's the minimum transfer price? It ends like that, like that. Right. So what we need is the incremental production costs, which we have already, by the way. Right. Which we have already, by the way. And then opportunity cost, which we need to calculate. All right. So this opportunity cost, I am going to give you the formula of how to calculate that. So the incremental production costs are generally the production cost per unit, the total production cost per unit, not the total, so the total variable production cost per unit. Right. The fixed costs are always excluded here. So which means that's already given. So for UNISA purposes, what happens is these incremental production costs, they are going to give you labor, they're going to give you direct labor, give you something complicated like that to, to vex your mind. So you can, in the end, come up with your incremental production costs as they are, right? So ideally, we'll have this under working one, where we are going to compile them together, and you have direct material, direct labor, variable manufacturing overheads. Normally those three. Right? You have those ones there. And then you total them up together per unit, and then you bring them here. Right? And then here, the only calculation that we will do is, let's put that on calculation one, is for opportunity cost. Right? So how do we calculate that now? First of all, we need to find the contribution. So what this opportunity cost basically gives you is the lost contribution per unit. That's what you basically are calculating there, the lost contribution per unit. Let me put it like that there, since this is a class. So this is gonna help you when you forget in the exam to know what your intention is. Lost contribution per unit. So you want to compensate them for that lost contribution per unit. So how do you calculate contribution? It's the selling price. Right. So let's find out now how much these guys are losing. They can sell this to external suppliers. They can sell that at 300 to external suppliers. So let's put that down there. So contribution is selling price less your total variable production cost. Let's say variable production costs. Right. All this is per unit. So where do we have that? We do have that up there. Right. It's the same thing there. 160. So sometimes this is not always going to be the same, right? Because, okay, let me not say variable production cost. Let's just say the right thing to do there is your variable costs in total. So which are going to bring about your variable production costs and your other variable costs, which under normal circumstances, you would have variable selling and distribution, right? So which means this here and that is not always the same, right? The difference being that to get your contribution per unit, you would have deducted your total, right? You would have deducted your total variable cost per unit there. So which will include non-manufacturing costs. Right. So the contribution per unit there is going to be 300 minus 160. So it gives us that there. So how we get that there, that opportunity cost now, or that lost contribution, right? It's gonna be the contribution per unit, right? Contribution per unit, which is the answer that you get there, right? Minus the units that you are sacrificing, right? The units that they are losing. So Oh, so did I say minus? It's supposed to be times. So times the units that you are sacrificing, unit sacrifice. So this basically gives you your total contribution that you've lost, right? This basically gives you your total contribution that you've lost there, right? And then you're obviously going to divide by the number of units, right? So what number of units? It's basically the same number of units that you find here to divide, say, your incremental costs, etc. Right. So let's have a look at what we are given here. Let's have a look at what we are given here. We are almost done. We are almost done. So what we're given now, we have contribution per unit. Right. What's our contribution per unit? It's 140. Right. We do have that now given. But now we then need to multiply that 140 by, let's go back to the question now. Right. They are currently, the pump division needs how much? They need 10,000. Right. They basically need the 10,000. So which means now we need to multiply that by our 10,000. Why so? Because these guys are also going to lose 10,000. So under the assumption that they do not have any spare capacity, so which means they are outright losing 10,000. Right. So that's the 10,000 that we are putting up there. Right. I'm just going to give a different circumstance later. 10,000. Right. And then what are we dividing that by now? So let's put that in brackets. Right. Now we are dividing that by the number of units that are being transferred. Then the number of units that are being transferred. So which is 10,000 there. So this is really going to give us just 140. So you take that 140 there and you put it there. Right. Take that 140 and you put it there. So which means the minimum transfer price is 160, which is the incremental production cost plus the lost contribution, which is 140. Right. So I'm gonna quickly now look at a situation where that 10,000 is not the same as that 10,000. So these guys are manufacturing 100,000, right? Oh, sorry, they have a capacity of 100,000. So let's put that down. They have a capacity of 100,000. 1, 2, 3, right? And then now that we are told that they are selling all of this to external customers, right? The division is selling all its valves to external customers. Then the one that's required here is how much? Let's say the required is 10,000. The required by the other division within the same organization is 10,000. So which is why the unit sacrifice there is 10,000, still 10,000 because they had a full capacity. But suppose now this was 90,000, or let's say this was 95,000, right? Okay, sorry, the capacity is 100,000, right? Suppose the one that they were selling to external customers is 95,000, which means they basically have an extra capacity, right? Which is idle there, which is an extra capacity of how much? 100,000 minus 5,000. So which means they can still produce 5,000 without affecting their external customers. So which means under this circumstance, if this is required, how much do they sacrifice now from the external? Because now they need 10,000. The idle capacity is 5,000. So they still require another 5,000 after that. So which means the shortage there is simply 5,000. So under these circumstances, they are sacrificing 5,000. So which is where now this would come and change there and become 5,000. So that would give you a totally different answer there. So it's not always the case that it's going to be it's not always the case that it's always going to be the same. So that amount is going to be 70 there. You see, so in our case now, the sacrifice and the units required is the same. Right? The sacrifice and the units required is the same. So which is why that becomes the case there. All right. So what questions do you guys have on this? What questions do you have? So which means our range, to answer this question here, our range is basically going to be, the minimum transfer price is going to be 300. So which is pretty much the same as that there. That's 300, the maximum price. So it basically gives you a price of 300. That's what they need to do that at. No compromise. All right. What questions do you guys have? What questions do you have?
Mr. Ndando,
Yes.
can you please go back to the question? I just wanna confirm the two 10,000. They're a little bit confusing.
All right. So the pump division is currently purchasing 10,000. So if they are currently purchasing that, that's the requirement that they have. So that's where we have that requirement there. And then here now, when they say, so this requirement is basically the units that you have to transfer from here, right? This is the requirement. So this 10,000 is this one, the one that comes, which is the denominator, that's 10,000 there. And then the other 10,000 is the 10,000 for, okay, the other 10,000 now is the 10,000 for the fact that, assuming that the valve division is selling all that it can produce. So all that it can produce is 100,000. So which means these ones do not have any spare capacity. So the other 10,000 there is the sacrifice. The other 10,000 is the sacrifice that they are making. Meaning that if this division is gonna sell to the other division, then they will basically be losing 10,000 from external customers. They need to sacrifice that from external customers. So consider now that they can be a situation where it's not the case, like here where we are saying their capacity is still 100,000, but they only have customers for 95,000. So which means the other 5,000 is just idle, right? We can make use of the other 5,000. There is no sacrifice required there. So the only sacrifice becomes 5,000. Then that's where that 10,000 changed to 5,000. Those are the circumstances there. All right. So I'm just going to put that up there in the group. I'm just going to put that up there in the group, and then we can see what we do on that. All right.